Hello and welcome to today's 10 at not quite 10. Um, Now, earlier on in this week, we were talking about paying yourself more, and we're going to continue on from that today. And we are going to look into personal tax planning. Now, personal tax is one of those things which affects virtually everyone who is either self employed or is a director of business. So, what we need to think about is what we need to be doing in preparation for paying our tax liabilities and some of the items we need to consider. So, first things first, tax year ends April 20, whatever it is. And the liability of the tax is due the following January. But you may also be required to make payments on account, which means that in July you could also be making an additional payment where basically you're paying 50% of next year's liability up front. Now, this is based on an estimate. HMRC is assuming that you're going to earn roughly the same next year. So they ask for 50% of it up front, which is always very helpful for cash flow, as we are all aware. Because you're making an advance payment against next year's liability, you've got these lumpy payments. It can cause big problems for cash flow if you're not prepared for it. And even worse, if they're unexpected for some reason, because we're perhaps not prepared, we're not forecasting, or if we haven't set the cash aside, the problem just escalates. So, what we're going to do is start preparing for any personal tax liabilities. We should be budgeting for the cash outflows. And most importantly, we should be setting funds aside. Now, it's up to you whether you set it aside in your business account or your personal account, but it does have a bit of a different impact for taxes if you pay it from your business account. But we'll go through that in more detail because that's often the preferred choice, is to set the funds aside in a business account. So, when it comes to personal tax planning, we ideally would like to forward forecast to see how much would be expected to pay so we can set aside as early as possible. If not, when it comes to the end of April, we can at least use the next 9 months to save. Now, this only applies for the first year because in the first year of paying personal taxes, we're not required to pay a 50% payment in advance of the next year just yet. We don't need to think of that until July the following year. So just make sure that we're prepared and make sure to waterfall. Now, think profit first here, and the principles underpinning that rule were basically set the cash aside, have a different cash account for it, don't touch it, set it aside just for personal tax, and then you can have this money set aside in a lovely business account and you can pay your personal tax liabilities from it. Just remember, it will affect next year's tax liability if you pay your personal tax from a business account, because essentially this is an additional dividend or an additional drawing. Now, I'm just going to share a little visual with you guys. So just pinning over. There we go. So here's one I drew a little bit earlier to give you a bit of a feel for personal tax and how it works. So say we're starting off in our first tax year, and our tax year is, of course, ending the 5th of April, 20, whatever it is. And we would be required to pay this liability on the 31st of January the following year. And at that point in time, we're paying 100% of the liability and we're paying down the arrears. So on this occasion, we've had the maximum amount of time to pay because we've essentially had 9 months. Unfortunately, if we're planning to have personal tax returns in the future, we will be required at this point in time to make a 50% payment in advance of the next tax year. So at this point in time, we've essentially paid 100% and 50%, and this is where the problem comes from, because if we haven't set that money aside, it's a very lumpy payment, and we all of a sudden scramble around for cash. We have to take more out of the business, which causes the business cash flow, etc. And we get these problems where if we haven't planned for it, it can catch us in quite a nasty way. So it's just something to really consider. Then, when it comes to July, 31st of July, we're required to pay another 50% payment in advance against the new tax year, which hasn't yet happened. So what we have essentially done here is we've paid 50% and 50%, but bear in mind this is an estimated liability that we're paying down. So when it actually comes to the 31st of January the following year, when we'll be required to pay down the second year's tax liabilities, We just need to pay down whatever the balance is. So we take away the payments in advance we've already made, and we basically pay the difference. But then we also had to pay 50% of next year's. So this is how it works. It's a bit of a never-ending spiral in the sense of you're constantly paying in advance, in advance, in advance. And going by the way that Making Tax Digital is working, we may see changes in personal tax moving forward when this applies to other business taxes, which it is quite likely to do so. So what we need to think about with personal taxes, are we setting the money aside? Now, another thing to mention on this one is because we've got these lumpy payments up front, usually what happens is people come to the end of the tax year, they haven't set aside in their actual personal account, so they take the money out of the business. Now, theoretically speaking, I'm going to use some very simplified numbers here just to make it easier. So please bear in mind the tax for the income I'm going to mention probably won't be correct. It's just to simplify the numbers. But say in the first tax year you have paid yourself £30,000 and you're required to pay tax on this. Let's say £5,000 worth of tax. Now, because you've already spent all the money you've drawn personally, this £5,000 worth of tax gets drawn out of the business on the 31st of January to pay HMRC directly. Fine, happy days, hasn't affected you yet. But next tax year, even if you draw exactly the same amount of income, so you draw another £30,000, you've actually had an extra £5,000. So all of a sudden your taxable income is now £35,000 for the following tax year. And then all of a sudden you find that next year you need to take £6,000 out of the business. Now it's this point where you see this bit of a cycle, a bit of a spiral, and this impacts a lot of business owners. So if you've encountered this problem, or you think you're going to encounter this problem, do not be afraid. It happens to a lot of business owners. But it's just be prepared that if you have to take it out of the business next tax year, it will impact your tax return as well. Because 9 times out of 10, you'll probably still take roughly the same monthly drawings. Most people tend to keep it fairly consistent, or if anything, increase it. But just remember, if you have paid personal tax from your business, it will impact next year's tax return, simply due to the fact of the timing of when you physically pay the cash out. So just one to consider there. Now, I get that obviously this topic has quite a lot of numbers in it. It's quite a lot of forward thinking. It's one of these subject areas which probably intimidates people a little bit, because personal tax planning and setting funds aside is one of these challenges which all business owners face. But please do make sure that you're getting a rough indication of, okay, I should probably set this aside each month, because even if you haven't set aside the full amount when it's due, it's a lot easier to find the difference than it is to find the full amount. So really, really important. Set the funds aside. Waterfall. Think profit first. The money's got to be better off. Basically, you want to pay yourself the same, but you really want to cover your tax liability without it impacting you. Because you could pay out of a personal account. Say you paid yourself the £30,000, you could pay yourself out your personal account if you've set the money aside. But the reality is you're basically paying out your net pay. That's the way to think of it. And most people don't really like to do it. They like to say, okay, this is what I have to spend, and then just pay the tax on top of it. But if you do that, make sure to waterfall. Set the cash aside and do not touch it. So most of all, do not touch it. Make sure it's there and it's left. So what I will say is, if you are thinking of planning for the future in terms of taxes, depending whether you have a bookkeeper, whether you're having an accountant, etc., they may be able to do this for you. But realistically speaking, you can actually start saving for tax years oodles of months in advance, just if you know roughly how much you're planning to take out in forward months. Obviously things change, but you can make predictions. So you can predict, right, this year I'm going to take the same as last year, and it gives you an indication of how much tax you're going to pay next year, and then at least you know how much roughly to set aside. Just bear in mind, taxes do change each year, so the amount might be slightly different, but as long as you've got something set aside, it's very beneficial. And remember, if you've saved a little bit too much in the account and you actually find your tax liability is slightly lower, brilliant. Just remember, profit first. That goes into your, essentially, your rewards account. and you can essentially draw that out as a little bit of a bonus for you if you so wish. So I hope you found this useful today. I know personal tax is probably one of those things that glazes people over when they look into it, but actually it's really important just to consider how much you need to be setting aside and when the liabilities are due. Now, if you did enjoy this video, please let us know in the comments. Likewise, if you have any queries also, please feel free to let us know in the comments. And if not, we hope to see you again very soon. Thank you very much for listening. Bye.